today. Now, today's session is on dominating the earnings season, which is upon us, kicking off this week. If any of you were expecting the Mastering Debit Spreads class, actually no worries. We thought we'd make a change because this is a lot more timely. This, as I said, earnings season is just kicking off. So what I'm going to be teaching you today is very timely and can be used right away. But no worries, we will make sure we send you a copy of our Mastering Debit Spreads class, so consider that a little bonus before we even get started here. So let's get started with our earnings season class here. For those of you joining us for the very first time, a bit about us here at Trading Wins. We are a group of pro traders with well over 30 years of experience. We're real traders and real teachers, and we've been developing our own strategies and trading systems and been teaching people from complete beginners to experts around the globe. Now, in today's presentation, I'm going to share with you the right way to trade earnings, or at least the way we do it here at Trading Wins. The first strategy I will go into, there's three different strategies I'm going to cover today. The first one is all about using implied volatility to your advantage. This is the one area where I think most traders, at least most new traders, go wrong when it comes to earnings season. I'll explain why and show you another way of doing this. Strategy number two will be how to use or how to put the reward to risk completely in your advantage. I'm going to show you a strategy where you'll be basically risking or a way to make 10 times your money compared to what you're risking. Neat strategy. And then the third one is really one of my favorites. It's a way to take advantage of that explosive move that tends to follow that earnings release. So a lot to cover in a short period of time. Again, we will answer as many of your questions as possible, time permitting. So let's get started. Please remember, trading can be extremely risky if you don't know what you're doing. So please do not trade with real money until you are completely comfortable with the strategy that you are using. Now, strategy number one, using implied volatility to your advantage. The rest of this presentation is going to be on my charting platform, actually walking you through examples. So let me bring that up here and explain where most traders tend to go wrong with earnings. You know, there's a big myth out there that earnings season can be a real windfall when it comes to trading profits. You know, we all know that most stocks, when they release their earnings, will gap one way or the other. And traders spend a lot of time pouring through financial statements and so on, trying to figure out which way that gap is going to go. And really, it's a complete gamble. It's anyone's guess which way that gap is going to happen after the earnings announcement. You know, a company can beat earnings significantly, but then lower their forward guidance and the stock tanks. It's really anyone's guess. So where most people go wrong is they will buy a call or a put on the day of earnings, just before that earnings release, and trying to take advantage of that big gap up or that big gap down. And here's the problem. Now, I'm using Thinkorswim here. I'm going to go to Trades tab and pull up the options chains here. And you can see that for every month, over on the right-hand side here, there's a percentage. That is the implied volatility percentage. Okay. Now, normally, what you will notice for any market or any stock, this happens to be the Dow Jones futures. Let's put in an equity here. Let's go to Monsanto, which I believe has earnings coming up soon. Let's have a look at the chart. Yes, they do, actually. Here, okay. So let's have a look at this. And most stocks will have a very typical range here for the implied volatility. In other words, if you look at Monsanto, on average, a very common average is about mid-30s, mid to high 30s, okay? And you'll see that across the board just about for every month, except when there's some type of announcement expected, like an earnings announcement, and then you will see this implied volatility start to spike for that particular expiration. And typically, what we want to look for is the expiry that happens the Friday after that earnings announcement, okay? So it is not uncommon to see this percentage spike higher and even go beyond 100% at times. So what tends to happen is that as soon as, a week or two before earnings, this starts to increase from that average up closer to that 100% mark, sometimes over. And then as soon as the earnings announcement is released, the very next day when the stock opens for trading, this implied volatility percentage falls back in line with its average. In other words, if this was at 100%, okay, and it falls back in line with the high 30s, low 40s here, that option contract you're holding will lose 60% of its value immediately, okay? And that's where that surprise comes in. In other words, it does gap in your favor. If you bought a call and it gaps in your favor the next day, you're waking up thinking, boy, when the market opens, I'm going to be making a ton of money. But yet, you're shocked when you see that you've actually lost money on that call. That is due to that drop in implied volatility. So what's another way around this? How can we get around this and actually use implied volatility to our advantage? Well, the advantage comes in by finding a proper setup and a move leading into that earnings announcement. In other words, you want to be buying 2 to 3 weeks before that earnings release and then actually exit the trade before that earnings release, so that that it doesn't gap against you and you don't lose everything you've made. So in other words, what you're doing by purchasing or putting on a trade before that earnings release is you're taking advantage of that period where implied volatility tends to spike. And if you're using a system that will give you some high probability setups, then not only can the stock move in your favor, increasing the value of those calls or puts, but with that spike in implied volatility, it really boosts your profit during that time. So it's a great time to be in a trade as long as you get out before earnings. Now, you never want to just buy a call or a put without a proper setup. So you need to be using a system like our favorite trade setup, for example, our winning momentum strategy that will get you in with a proper setup leading into that earnings announcement. The other reason for this, and let me show you another example here. Another real positive about buying 2 or 3 weeks before that earnings announcement. Okay, here's PVTB. They have earnings coming up soon, and you'll see that the October strike here is almost 60% compared to the mid-30s. Okay, it's very common. You'll be able to see that over and over again. But the other thing is, let's say we had a buy signal here a couple of weeks ago, and we purchased a call leading into that earnings announcement. Now, that spike in implied volatility is going to increase the value of our calls, okay? But what if the stock started going against us? Well, because we have that spike in implied volatility, okay, it will cushion the blow. In other words, even though the stock may go sideways or drop slightly, that spike in implied volatility will make up for that slight drop. So if you do end up being on the wrong end of a trade during that time, your loss should be smaller based on that spike in implied volatility. Okay, so what you want to do is identify the upcoming earnings announcements. One way to do it, if you use Thinkorswim, is just plot the corporate announcements on here from the settings, and that will put on these little red buttons at the bottom here identifying the dates of the upcoming earnings announcement. You can see this one is October 13th before market, okay, on PVTB. Another way you can, there's a website that you can use. Now, I'm not affiliated with them in any way, but I just thought I'd share this with you. It's earningswhispers.com, earningswhispers.com. They have a calendar feature here. You can select by date here and run through them all. So in other words, you can move ahead in the calendar, figure out who's releasing earnings 2 or 3 weeks before, mark those in your journal, and then start monitoring those charts and look for those proper setups on your chart to enter those trades and take advantage of those earnings announcements, or that spike in implied volatility leading into that earnings announcement. Of course, you do want to be out of that position before earnings, okay? So that is one. Now, let me cover another one here. Strategy number 2, giving yourself a 10-to-1 reward to risk trade setup. Okay? Let me bring my charts back up. And this one, there's a few moving parts to it that I want to show you. One thing I want to share with you is a unique way to plot support and resistance on your chart. And you'll understand as I go through this explanation, but you can use this with any strategy, and it doesn't have to be during earnings season. It is useful all year round. So when it comes to support and resistance, you can use support and resistance not only to identify turning points for that particular market, but also to help yourself set targets for particular trades. But where most people go wrong is they will take support and resistance levels off the same time frame chart that they're trading on. In other words, if you're trading on a daily, they'll mark the highs and lows or the pivots and use those as support and resistance. And there's nothing wrong with that. That you can certainly use it. But what you're doing is just identifying the average areas of support resistance, not necessarily the strongest areas of support resistance. And the way to quickly and easily identify the strongest areas of support and resistance is by doing two things. You can move your time frame up one period. So in other words, if I'm using daily, I'm going to switch to a weekly chart. Okay? And let me give you an example here, a clear example. Let's move to JP Morgan, okay? So you can see on this chart, JP Morgan is kind of all over the place, a nice sideways back and forth here, but if we switch to weekly, it's a lot smoother, okay? And then not only are we going to switch to weekly, but we are going to switch our chart style to a line chart, okay? And this will help visually and will help us do this very quickly because what we're looking for are these points, these pivots, okay, on the chart. And we're looking to draw a line at the areas where we see multiple points touching around the same line. And it's more of a zone than a line. So getting the exact spot where each tip ends, it doesn't have to be that exact. It can be a zone. So you can see there's 3 points here, 3 or 4 points here that hit that line. And really the rule of thumb that you want to use is 3 or more. Okay? So what you want to do is start at the top of the chart and you want to work your way down and identify these areas such as this where you have, see here, 1, 2, 3, 4, 5 points, okay? Significant areas of support resistance. There's another one right around here. This one has multiples. Look, 1, 2, 3, 4, 5, 6, okay? Many. So 3 and higher is great, but the more you can get, the better. We'll just do one more here, and then we'll move on right around here, okay? You can see again, 1 here, 1 here. Doesn't have to be perfectly on those tips, but more of a zone. But you get the idea. So what you want to do is go from the top of your chart all the way to the bottom, mark those lines, and then switch back to the time frame that you normally trade with, and switch back to your same chart style, be it bars, candlesticks, etc. And you can see that whenever the price action reaches an area of significant support or resistance, it tends to do one of two things. It will either bounce around there for a while, okay, or it will bounce off there immediately. Now, you can see how well this works, where it comes down, it sort of bounces around for a while, it comes higher, tests it again, and then when it bounces off it, what it tends to do is go to the next level of support and resistance, and that's where you can set targets. In other words, if you're entering a trade here, for example, on this pullback, there's a nice target, the next significant level of support and resistance. Okay, but you can see just how well this works, bouncing from one line to the other and pretty much stalling every time it gets there. You can see it breaks through, comes back, retests it, bounce. Where does it go? The next level, bounces around, pulls back a little, breaks through. Where does it end up? Right at the next level, back and forth. So they're very, very effective. It's a very, very effective method of identifying where a stock may pause for a while, okay, or where the next target may be. So how can we use this around earnings season? Well, let me remove these charts or these lines and show you. Let's take, for example, a stock like Netflix, okay, which tends to have some fairly large gaps during earnings season and actually has earnings coming up. Let's see, when is it? The 14th, October 14th, after market close, okay? So now, when it comes to identifying the gaps or trying to guess where that price action will end up at expiration after that gap, up or down, you can do a couple of things. You can look back at the previous earnings reports, okay, like this one, and measure the gap, okay, measure the distance. And Netflix here tends to gap about 10 points or so on average. Every once in a while, it goes 15 to 20, but on average about 10 points or so. So let's say we are at the day before earnings here, okay? Let's say they're releasing earnings tomorrow. We can look at where we are, and we can move 10 points higher and 10 points lower. And then also plot those significant areas of support and resistance on our charts and see if any of those align. So in other words, we're at 106 here, okay, 107. So we'd be looking at about what is it, 117 or so, right in around here. Okay, let me just draw a line there. Right in around here for that top end level. And from 106, we'd be going down to about 96 or so to identify our lower target. Now, let's say that these were also, you can see there is some support and resistance here, although it's on the same time frame. But if we did this on the weekly and they landed there as well, now those are good targets for us to expect a gap for Netflix to come into that area and settle there on expiration. Remember, we only want to look at the expiration that happens immediately after the earnings. So in most cases, you'll be looking at weeklies, okay? Now, the option strategy you'll be using for this is known as a butterfly spread. And a butterfly spread is a combination of a debit spread and a credit spread that overlap on the short strike. So let's look at this and pull up the option chain and actually plot this out. So we're going to be looking at the 117, we'll probably have to look at the 117.50 level and somewhere around the 96 level. So if we bring up our chain, we'll go to the this option. We'll use today's because we're assuming that tomorrow's earnings. So we'll take this week's expiration, okay, and we'll identify these targets here. So we'll look at the 117 here to the upside. We'll look at the call side. We'll right click and we will buy a butterfly, okay? And you can see that it is made up of a debit spread and a credit spread. So the debit side is you'd be long the 116 and short the 117. And then the credit side is you'd be short the 117 and long the 118. So that's why you're seeing that there's twice as many shorts as there are longs, but it's all covered, okay? So the real advantage here is look at the price. 2 cents for that credit spread, okay? That's all you're spending. There's 2 cents for that credit spread. So even if you're doing 10 contracts like the default I have here, and your total cost is $200 plus commissions. Or actually, sorry, it'd be $20 plus commissions at 2 cents. Okay, so very, very inexpensive. But now let's plot this on our Analyze tab and have a look at this. Okay, so you can pick it up for a penny or two. All right, and here's your risk graph. Okay, now what we can do if we want more profit is to widen out the strikes. Okay, right now we're using $1 strikes. So what you see here, you see the zero line here, this flat line? That's the zero line, and anything under this little triangle here, this tent, on expiration, okay, if the stock lands anywhere in between that tent, so those are the break-evens, the 116 on one side and 118 on the other, so the outer strikes are your break-even marks. If the stock ends up on expiration anywhere in between here, you're going to be in profit. Okay? Anything above 118, you're going to be at a loss. Anything below 116, you're going to be at a loss. And your total loss will be the amount you paid for this spread. But the difference is you can see that here at a penny, okay, and even if it was 2, you'd be losing about $20. That's what your maximum risk is. But your potential profit is much, much higher here, okay, on this. So, you know, normally it's about 1 to 10 that you'll find around earnings season with butterflies, 1 to 10. So you're risking 1 to make 10. And so it's a huge advantage. So because you can put them on so cheap, you can put one on either side. So you're spending $10 or $20 on one side, 10 or 20 on the other, for the opportunity to make several hundred. Okay, a very inexpensive way to try to play that, and a fairly safe way. Now, a few keys that you want to know about and remember about here is, number one, you do not want to get exercise on butterfly spreads. So expiration, if you are in the money on any part of those spreads, you want, okay, and the other on these, if you're having trouble selling the spread, the full butterfly spread as one order, you can break them down and sell, close out the debit spread portion and the credit spread portion. Typically, you'll get easier fills that way. Okay, but again, you're risking 1 to make 10 in most cases. That's why you can afford to put them on both sides. All right. Now, we're getting short on time. Let me show you our next strategy here, which is one of my favorites, how to take advantage of those explosive gains after the earnings release happens. Okay, so let's look at this. Let me clear this chart, and let's look at a few examples here. Now, I'm going to do a few things. I'm going to add one other indicator on my chart here. I'm actually going to clean this up. I'm going to remove the 20. We are going to be plotting one simple indicator on our chart, and that is known as the Keltner channels. Okay? They're widely available on most charting platforms, so you don't need to be using TOS for this. You can use just about anything. And we are using the default settings. I'm not changing anything on the Keltner channels. The only thing I am going to do is thicken up the outer bars and make them the same color. Okay, so let's make them black here, just so they stand out clearly. 2, and make these black. Okay. Oh, wait, someone said yes. You can hear me now? Okay, I've dialed in. Sorry about that. Hopefully we haven't lost too much time. Okay, great. You can still see my screen, hopefully. Okay, let's carry on. So when it comes to this last strategy, what you're trying to do is take advantage of that explosive move that happens after earnings. So what you want to do is let the earnings release happen and then wait for one full trading session. So in other words, if earnings are released before market open, you want to wait for that full day to go by, and then you're looking at entering the following day. If it's after market close, again, you're waiting for the next day's full trading session to end, and then the following day you will enter. And this is what you're looking for, okay? Yes, Michael, the default setting is 1.5 on the Keltner on most platforms. Once that session is over, when you get a gap, okay, what you're looking for is not only for the price to move outside the Keltner channels on that gap, okay, above or below, it really doesn't matter. If it gaps above, okay, what you're looking for is for that session, that next trading session, to close above the Keltner channels. So if I zoom into this area, you can see that this actually did close, okay? It briefly came within the Keltners, but it did close outside the Keltners. So now all you're doing is you're marking the high of that bar, and you're waiting for a trade above that bar to get you in. And you want that to happen as quickly as possible. So really, the most I would give this is 2 bars, but if it happens on the very next bar, it's even better, okay? Because what you're really trying to do is jump on for that momentum move after earnings, that runaway gap. So once you get that trade above that high, you enter long in it, and you can use any, many different option strategies, right? You can buy a call here. You can sell a put credit spread. You can buy a debit spread. Many things you can do about that. If there's time, we'll touch on that. But once you enter long, you're going to sit on this until you get a close below that upper Keltner channel, okay? You could have taken it here or here. That is your exit. The exit strategy you'll be using is a close on the opposite end of that Keltner line. Okay, so for long trades, you need a gap above and a close above. Then you need a trade above the high of that bar, and your exit is when you close below the upper Keltner channel. Now, there's nothing stopping you from scaling out of this trade along the way. If it's a monster move like there was on Yahoo here, you want to be taking profits along the way and moving your stop up. You can do that, but this is your ultimate exit. So let's find out and see how the others would have worked. Right over here, you can see that there was a gap here, but it never did trade below the low here. It moved higher, so we'll skip that one. Same with this one. This one actually, after earnings, it ended up in between the Keltner line, so not valid. Same with this one. So let's go through a few other examples here. Let's look at Walmart. Okay? To the far left here. These earnings back last November. It gapped here, right here, and closed above. So then we mark the high of that bar, okay? We enter long, and we're in until we get a close below the Keltner line, okay? And you can run through it. This one, you can see a gap in never, well, actually this one did close below, and we actually did breach the low, but then it immediately went back above and closed above. So the main thing is here that when this happens, your losses will be small compared to your gains. Because if you look back here on this latest example, we had a nice runaway gap here. And that's really what you want to be in on, are those runaway gaps, okay? And then, and again, you can scale out as you go, which is an even safer strategy. But you could have here sold a call credit spread. You could have bought a bull call debit spread. You could bought a put spread, or just a straight put, or short the stock. And there are many things you can do with these. Let's quickly go through a few more examples, and then we'll try to get through some questions. Let's look at Disney.
for example, here with Disney, we did gap outside and close outside, but we never did breach that high, so not valid. On this one, though, in February, we did gap above, close there, we did breach that high, and we're in it all the way until we close below here, the countdown, okay? This most recent example here, we gap down, we trade below the low, and there's that runaway, okay? Huge move lower. So something that works very well and great to use on any gap, really, but around earnings season, you can mark your calendar with those earnings dates, and you can expect those gaps. So remember to wait out that one day, and then look for those gaps outside the counter bars and follow those rules, okay? So let me have a look here. I know there's a number of questions, but before we get to those, I promise I'll answer as many of those as I can before our session is over. But before I do that, let me tell you about a on-demand recording that we have, what we call Crush the Market with Options. In this class, we'll teach you a great way to make a steady weekly income using credit spreads. We'll go into more detail on those butterfly spreads, and I'll show you how to use them all year round. There's actually another trade that happens quite frequently, usually once a month on stocks. That, again, you can risk $90 to make $1,000 on those trades. We'll teach you a couple of different delta neutral strategies that you can use in any market conditions, especially those trending sideways choppy markets. We'll go through those in details, and most importantly, we'll show you several ways to repair your trades when they don't go your way. So the link for this class is tradingwins.com/crush. But before you order, let me tell you exactly what you're going to get so you know that it's right for you. As soon as you order and your order's processed, usually takes about half an hour, you will get a link to the on-demand recording of this pro class, which you can access from anywhere with an internet connection, and it is yours for life. You can view it as many times as you like. We have decided to send you a second recording of different class. The most recent one we did in July on this subject, because for every class the Q&A is different, and more recent examples, it's great to have more than one. We're also going to throw in a 30-day membership to our pro membership. Let me tell you a bit about that, because that really is one of the best parts of this. The pro service is the most powerful way to get access to all our systems. You'll also get real-time trade alerts showing you entries, stops, and targets. You'll also have access to our premium nightly videos, which is a great way to learn the various systems that we trade. And you'll have, as a member, access to our live weekly market chats. They normally happen every Thursday morning from 10 a.m. to 11 a.m. Eastern. You get to come into our room, ask me any trading-related question you like. They are also recorded, so if you can't attend live, as a member, you will receive those recordings. So during this 30 days of membership, you will receive 4 separate recordings. The next one is actually tomorrow morning, because I'm traveling on Thursday, so tomorrow morning is this week's session. And in addition to all that, you have access to all our past educational sessions, which are on our website and available to you to watch at our leisure. So all of this is valued $691, but we really want to give you a chance to see what we do here at Trading Wins. So for anyone on this webinar today, all we're asking is $47. Now we're making that available to the first 50 people. tradingwins.com/crush, just $47, and this is everything you will get. Very timely for not only the market environment we're in right now with all this additional volatility, but especially with earnings season coming up. Again, it's tradingwins.com/crush. Now, if there's time, I'm going to bring in our our coaching coordinator, Raul, to come in and help me read off some questions quickly before we run out of time. Raul?
It's the second time we've had technical difficulties, but always a pleasure to have you. I got a lot of questions, so let me get through them quickly. With butterflies, the question was from Robert. He was saying, excuse me, from Barney. He was saying, butterflies are a great tool, but do you ever worry about the commissions on those kind of trades?
You know what? That's something that would have worried me a lot more many, many years ago. These days, commissions are so inexpensive that it really is insignificant. But yes, you will incur additional commissions. But more often than not, you're letting those expire worthless, so you're really only paying commissions on the way in.
How much of the discussion in the pro class is on more exotic option strategies? That's from Lisa.
Yeah, we go through a lot. There's a lot, and you know, the combination of those two recordings that you're going to get is almost 6 hours of class time. So we are going to go into many different options strategies during the class.
That was Roger's question as well. How many hours of these recordings? How? From Linda, she was saying, what's Vince's favorite earnings strategy?
Honestly, my favorite is that last one I showed you with the Keltner channels. But again, they're all very effective, and we should see some nice gaps coming up this earnings season.
Charles is asking, how much attention does Vince pay to the Greeks?
It depends on the strategy. We go through that in the class. Absolutely, we'll cover a lot more of that in the class.
Sorry, Vince, can you just repeat when the last class was held?
Let me go back to the slide here. The last class was July 31st. So you're going to get 2 separate recordings of that. And then as a great follow-up, those 4 sessions during your 30-day membership, the live market chat, you get to come in to the class and ask any follow-up questions you may have.
This name looks familiar. Rosa, I think she's a member. She was asking, do you cover SPY credits, right?
Yes, it works on just about anything, absolutely.
Trevor saying, for the butterfly, what's the duration that you usually keep it on for?
We usually put it on, you know, a day or two before the earnings announcement, but in the class we will talk about the other ways and other times you can use those butterflies and exactly how long you want to hold them.
Aaron's asking, what's the highest probability option strategy that Vince uses?
You know what, there's a few, and actually there's a number of strategies we use. Again, the nightly videos we send out with our pro membership, you will hear about all of those. We highlight trades almost on a nightly basis, so we'll cover those during the live market sessions and our videos as well.
Rosalie's asking, I'm a beginner, is a $47 class good for me, or should I start with something that is even more basic?
No, I mean, there's a lot of basic information online. This is really meant to take your options knowledge to that next level in a very short period of time. So what I do is cut out a lot of the fluff that you would otherwise have to read through in textbooks and so on, and just give you the core that you need to trade with. So I think it's a great starting point.
Cross is asking, apologies, I've already gone over, but what size of account is required to trade these strategies? Well, used to futures, not options.
No, that's the beauty of it, is that you don't need a lot of money to start with. Again, the butterflies, you saw that example, $10, $20, and you're in the trade. And also that the class we just did on mastering debit spreads, which you'll also receive a copy of today, the whole purpose of that was to show you how you can reduce your risk and trade in this market with a small account. So
you're just in a giving mood. Class after class. So you will get there was a link already in the chat box for that mastering.
Is there? Okay, great.
Class.
Excellent.
We will put it in again. If you do need to call us to place your order, you can do that as well. It's 1-888-574-2426. That will also be going in the chat. If you need to contact us, it's info@tradinglink.com. The website to order is tradinglink.com/crush, as in crush the market with options. How long before earnings season should people be starting to get their strategies together?
Well, I mean, you know, for the one we buy the furthest out is about 2 to 3 weeks. So, but earnings season is just kicking off, and it's going to last several weeks. So that's why we wanted to do this class today. It's very timely.
Mira is asking a good question about the 30-day membership.
Oh, thanks. At the end of the 30 days, if you're enjoying your membership, you don't need to do anything. It'll automatically renew at $97 a month. But if for whatever reason you'd rather not continue, just give us a call and we'll put a stop to it. Okay, it really is the world's easiest cancellation policy.
It's very easy if you ever need to. Like I said, the phone number is already in the chat. If you want to order by phone, it's 1-888-574-2426. Why do you have the class limited to only 50 people?
Because of the number of questions. Our goal for that class
is to answer all your questions so that when you walk away from the class, you can start trading this completely on your own. And so we get people from all different backgrounds, and we need to limit the number of questions. So it really is.
Rosalie's asking me a very funny question. She says, do you have a normal phone number, not a toll-free one? Yes, we do. We have a normal one. We'll put that in the chat box. We've never had anyone ask if I can call you. No. If we can call you, call you long distance or call you a little local number, but no problem. We'll get that for you again. Mira's asking what the number is. We'll put that in. Rosalie's saying she's calling from overseas. That's a valid explanation. We have a lot of members from. We've got a lot of members from the UK, Malaysia, Australia.
Oh, yeah, it's all over the place.
You were talking about gold and Japanese yen. How do those things affect earnings?
Those, I mean, they really don't. They affect the overall markets. So, but again, in our nightly videos, we go through that. And in the class, we'll show you not only how to use these strategies, but when.
Does Vince prefer debit spreads or credit spreads? That's from Lenny.
It depends on when and where the setup happens on that particular stock. Again, I don't have enough time to go through that now. I'd have to show you on the chart, but in the class we go through several examples.
Mark is saying, what are Vince's preferred delta strategies?
Well, if you're just going straight long calls or puts, I prefer the delta 70. 1 or 2 strikes in the money for shorter term plays, and then the 20 or 25 delta for longer term.
Sure thing. I just ordered the class, but haven't received the recording yet. How long?
It takes about half an hour for your order to be processed, so expect an email with a link to those recordings.
He's also saying, when will his pro membership be ready?
Usually, within 24 hours. We'll try to get it ready for you for tomorrow morning. Oh, it might be ready in the next 5 minutes, we're being told. I think the reason why our staff is all over this is so you, if you want, you can join us for that live market chat session tomorrow morning.
Saying, how often do you have your trade orders?
Well, we give usually trade ideas almost every night in the videos. Our videos are sent out from Sunday to Thursday every week.
Does Vince prefer trading stocks or options?
I almost exclusively trade options now. You'll hear a lot of that.
Randall is saying, can Vince please comment on leaps?
Actually, I do leaps for the longer term plays. Again, that's all part of the class.
So that is in the class. There's a section that we've done on longer term kind of
right
as well.
Right.
Roger was saying, how long are those nightly videos?
They're usually around 10 minutes, 10 to 15 minutes long.
All right. What does Vince think of straddles and stranglers?
I don't use them as much. I think they're very difficult to trade, or at least to profit on. So I explain again that in the class, but what I'm going to show you is much more effective, or at least that's been my experience.
I've got less than a minute. Mike is saying at $47 is a no-brainer. I bought some of Vince's courses in the past and felt that they were worth every penny. Thanks so much, Vince.
Thanks for the kind words.
Trevor was asking you to discuss long option repair strategies.
Yeah, the repair strategies are a key component of this and can be put on with any time frame, actually.
John was asking, will a recording of today's presentation be sent out to
I believe
there's a small cost.
No, I believe it will be, yes.
Not a problem. Any books that you would recommend on learning options?
There are several. But really, a lot of that information is also online now on YouTube, so you can save yourself time. But we can gather a list of some good titles for you.
Hope you can enjoy the class. Wrap it up, Vince. Last word.
I think we are out of time. The class link is tradingwins.com/crush, as you see on your screen here. And this is everything you are going to get. If you have any issues with your order, just send us an email, info@tradingwins.com. But on that note, thanks everyone for joining us and for having me back. A big thank you to Reed and everyone else at Investor Inspiration for having me back on. Hopefully we can do this soon. With that, Reed, I will pass it back to you.